Hey, thank you very much for joining us today. My name is Ian Scott, and I am the founder of Scott Legal. And today we are going to talk about what I would call an underutilized visa, which is the E-1 visa. This is a visa based on trade. I know that the big brother or big sister of E-1 is E-2. We see a lot of E-2 visas, and that's usually the one that's talked about. But E-1 can be a great visa if you do actually meet the requirements. Before we get started or jump into the actual requirements, a few housekeeping items. This webinar will be recorded and we will put the webinar on our YouTube channel. We do regularly post YouTube webinars and videos to our channel, so we do encourage you to subscribe. We post 2 or 3 interesting videos a week, so that's something that you can take advantage of. And if you hit the subscribe button, then you are going to be notified when a new video has been posted. We will send out a number of things after the presentation. We'll send you a link where you can get to our YouTube channel. We'll send out a copy of this PowerPoint presentation. We'll send out a guide, an E-1 visa guide, and then we will also send you something where you can set up a consultation if you have additional questions. If you do have questions throughout the webinar, please feel free to add them to the chat or the Q&A box. We will have time to get to all questions. So without further ado, let us jump into the E-1 visa requirements. So this is a visa that is based on trade between the United States and the treaty country. So there are a number of treaty countries, over 70 treaty countries, and really it's just that the United States has signed an agreement with these countries. So both countries allow for citizens of their countries to live and work in the United States to facilitate trade based on whether or not they meet these particular requirements. So the U.S. form of these requirements are the first one's a extremely objective one. You have to be a national of the treaty country, and what being a national of means that you have a passport from the treaty country, and there are countries in Europe, Latin America, Africa, Asia, really all over the world. And you have to have a passport. Your place of birth doesn't matter, so you can have multiple passports, but as long as you have a passport for one of the treaty countries, that's what is important. And then the trade has to exist between the treaty country and the United States. And when we think of trade, it can be anything. It can be car parts, it can be widgets, it can be food, it can be alcohol. The trade really can be anything. And everything that I just mentioned, they're products, but the trade can also be services. So you could have an IT consulting business in the UK, for example, that's providing IT consulting services to clients in the US, and that is considered trade. And when we talk about trade, we're talking about exchange of money for a good or service, right? So that's going to be the trade. Now, a few things to keep in mind that, when you're looking at this, is that the trade, the reason this exists is because there's trade between the treaty country and the United States. So sometimes what the big issue with respect to E-1 visas is that the trade isn't between the United States and the treaty country because the goods might originate in some other country. Like, so let's say the goods originated in Vietnam, for example, and then they were shipped to the UK and then shipped to the United States, then that could be problematic. Also, if someone's providing a service, even if the company is located in the UK, for example, and the people providing the services are in the Philippines, then that would not qualify either because the service actually is not being performed in the UK. So there's an argument that the trade is not, or the government will likely feel that the trade is not between the United States and the treaty country. So the trade also must be substantial. That is not defined, but I think that if you have less than a couple $100,000 of trade between the United States and the treaty country, it probably is not going to be a strong E-1 case, but definitely, every case is unique. We talked about the trade must be international between the treaty country and the U.S. And then the applicant is really coming to the United States to engage in trade activity. So for this particular visa, the applicant doesn't have to, live in the United States. They don't have to spend all the time in the United States. They really have to be coming here to facilitate trade. So that's something that that is different, I think, from some other visas that we see. And then there's always going to be an intent to return home after you don't have the visa. So I talked about this a little bit already, that goods can be, the trade can be goods such as fabrics, cars, computers, really any good that you can think of, but they can also be services. And I really feel that services, a lot of the E-1s that we do, they actually do relate to services. And that's, I think, an ever expanding area, because I think when a long time ago, I think that the focus was on goods for trade, but now we do see many services. And when you're trying to show the trade, sometimes I think the starting point is going to be, okay, let's look at the revenue of the company. So let's say the company has $1 million in revenue, and you say, okay, well, how much of that relates to the company trading with other countries? So let's say the country doesn't sell to their own country at all, and then they have sold $400,000 of things to, let's say it's a UK company, they sold $400,000 of things to the UK and $600,000 of things to the United States. And I think that what you always want to do first is get an understanding of the total population. So in this case, the $1 million, and then make an assessment as to what percentage relates to trade with other countries and what percentage relates to trade with the United States. And the reason this is because the rules say that at least 50% of the trade has to be with the United States. So it has to be substantial, and then also 50% has to be with the United States. But you always do need that control figure to be able to prove that your trade actually has risen to the at least the 50% point. And the what we call kind of internal trade or internal selling, that's going to be excluded from that calculation. So in terms of when we're trying to provide proof of trade, that it's going to be invoices. If you're shipping things, shipping documentation. If you're providing services, the invoices are going to be clear that they're for U.S. clients. It could be bank statements. It could be tax returns. Anything that shows that there actually is trade, and that trade is with the a member of the treaty country. And it can go either way. It can go United States to the treaty country, or the treaty country to the United States. So how much is enough? Because I said earlier that it's substantial trade. There is no definition, but I really do think that you see on the slide I said 250,000. I think if you had 200,000, then maybe you could give it a shot as well. But you do want to also, I think, to make a good E-1 case, a large number of transactions. So if you traded one or two items and then they came to 200,000 or 250,000 or 500,000, then I think that you would have a hard time proving the requirements for this particular visa. So the consulate will focus on a number of things, like the number of clients and transactions as well, where single transactions may not be enough. The one good thing is the regulations are very, very clear that small businesses can qualify for an E-1. And when I say small business, if you have a couple of $100,000 in trade or $250,000 in trade, that's small, right? They do consider that small, but that can actually qualify. And you do want the trade to, this isn't really getting at as much trade existing in the future. You do want to really look at what has been traded in the past and see if you meet the requirements there. And then you want to also show them that that trade has been substantial over a period of time. So I just said this, that whether, does the trade have to exist already? It does. It's not going to be kind of a perspective showing them on a business plan that you plan on trading. Instead, you really want to show them that you actually do meet that. And we talked about the 50%. So let's go through an example here. And I think this is similar to what we went through before, but company in Spain manufactures glass and exports it to other countries. And within Spain, so let's say the breakdown is as follows. They say they sell 100,000 to Spain. They sell 50,000 to the 500,000 to the United States, and they sell 500,000 to China. Well, in this case, the 50% works because the actual total trade amount is going to be 1 million, and 50% of that is with the US. So it works because the sales within Spain are not counted for the purposes of calculating trade. Whether you should apply USCIS or a consulate, generally applying at a consulate is always going to be better for a visa, an E-1 or E-2 visa, because you're going to get the visa normally for a longer period of time. In most circumstances, if you're eligible for the visa for 5 years, for example, like someone from Germany, UK, Canada, then you would get the visa for 5 years, versus if you were in the United States, you would apply for USCIS filing, and you would be granted 2 years, and you wouldn't be able to travel. That would be 2 years within the United States. So generally, a visa is better. So we normally advise going to a consulate and getting a visa. A business plan, one of the things I'd say is that whenever there are many people who are eligible for an E-1 and an E-2, and we would always push them for the E-1 as long as they were eligible, if they were eligible for the both and for both. And why is that? Well, E-1 is a lot easier. It's based on past information. So E-2, you have to do a bunch of things. You have to set up an entity, you have to buy things and things like that. The E-1 is going to be based on past information. The E2 is going to be a situation where you have a lease. You need a lease. Not explicitly required, but it definitely is very helpful for the application. Whereas E-1, it's not relevant at all. No investment required for an E-1. And the great thing about E-1 is no, you don't have to hire US employees, right? So you don't need a business plan for an E-1. Sometimes it's a good idea to include one if your trade is on the lower side to show that your trade is going to expand, but you don't need one for an E-1 generally. You don't need an entity in the United States. Yeah, so these are all good reasons why an individual might prefer an E-1 to an E-2. So why are E-1s, even though I say this is a great visa, why is it that sometimes E-1s are denied? And keep in mind the approval rate is high for E-1s. Past results don't predict future outcome, but approval rates are high for both E-1s and E-2s. But some reasons, trade is too low. So that's a big reason. Another is very few clients. The other is not enough transactions. So this is similar to the second bullet point, but there is a distinction. There is a distinction because obviously if you don't have very many transactions, you're not going to have a lot of clients. But sometimes even when you still have a large number of transactions, but just, one or two clients or a few clients, that can be a problem as well. The 50% threshold, that sometimes can be confusing to people, and sometimes they won't calculate it correctly, so that can be a problem. And then the final reason is that the trade doesn't exist. So people are trying to get the E-1 based on a business plan versus getting the E-1 based on actual results. In terms of renewing an E-1, the good thing about this as well is that all you really have to do is update the information on the trade, right? So, and another thing to keep in mind is that unlike an E-2, the E-1 does require activity abroad, right? Because you can't be the only person in the company abroad and then get an E-1, because that means that the trade isn't going to occur anymore, right? Because if let's say that you're providing IT consulting services and you're in the UK, and then you come to Canada, then start advising US clients, and you don't have any staff in the UK, then the trade doesn't exist anymore because you're in the United States now. So just because I may have thrown in another country, but let's say that you have an entity in the UK. The UK entity is providing IT consulting services. You move to the United States and you apply for an E-1, and you don't have any staff in the United States, then that is going to be problematic because there's no longer trade between the United States and the UK. So really renewal is just kind of updating the information and showing that you're still at the 50% mark. And that's something you really have to pay attention to, because even if you have substantial trade, but the trade starts expanding, but you start trading more with other countries, that could be problematic for the E-1. You should always check the website where you're applying as well, the consular website, because the rules often change with respect to how to put this together. Perfect. So that's all the prepared remarks that we had for today. So to the extent you have any questions, and I'm just taking a look to see if there are any questions in the chat function here, and I don't see anybody say any. But yeah, but as I said, a few things to keep in mind. If you have a choice between E-1 and E-2, E-1 is often a better choice for the reasons that I outlined. It's just easier to just easier. And if you do have questions, I see someone's raised their hand, but if you do have questions, if you could just type them into the chat, function, and then we will be able to get to those questions, either the chat or the Q&A function, and we'll get to those questions. But just do it quickly as we're going to sign off soon. The other thing that, again, we were going to, the housekeeping items, we're going to send you a copy of the presentation. We're going to send you a copy of the E-1 visa guide that has more detailed information on the E-1. We're going to send you a link to our YouTube channel, and so you can see this video, but also see other videos, immigration videos that are there. And then also a link to a consultation where you can set something up. So I do see one question in the Q&A. So if export is from the US to my country? Yeah, so that too is fine. The trade doesn't just have to go from the country to the US. It can go either way. So when you're looking at the international trade, it really can go either way. So that's not a problem at all. Perfect. So thank you very much, everybody, and definitely reach out and schedule a consultation if you have any additional questions. Thank you.